Okay, good afternoon, everyone. Welcome to Polaris Trading Group's PTG University Wednesday Workshop Educational Series. Today we're going to start a new module series that will take us through the very basics to the more advanced concepts that we use on a day-to-day basis in our trading room and in our methodology. Today's topic is going to be pivots, the DNA of market structure. Today is Wednesday, February 11th, 2015, and I would like to dedicate this presentation to a very good friend and mentor of mine by the name of Christina, who taught me quite a bit about pivots years back, and I'd like to pass that knowledge along to you today. So before we begin, just want to highlight some of the core disclaimers that need to be presented and shown to everybody. Simply, the bottom line is trading in futures and options on futures and speculative nature, and involves substantial risk of loss. And past performance is not indicative of future results. And the presentation here is and commentaries today are educational in nature and simply are designed to contribute to your general understanding of financial markets, technical analysis, and the Polaris Trading Group's methodology. So part one, we'll start there with a simple introduction. And simply, pivots are real-time signals for real-time profits. Pretty basic. Some of the goals that we want to try to learn from this presentation and moving forward is we want to learn to identify pivots. We want to understand their market structure or trend structure. They actually will build structure for the development of trends. Simply, drawing and using trend lines, study trend hierarchy, which basically pivots build upon each other, and as the day unfolds, creates stronger and stronger structures. Pivots are used for trade entries, exits, and trade management. We'll see plenty of examples of that in some later slides. So what you'll learn here about pivots are universal principles. You can take this anywhere. You can use this on any chart, every time frame, any time frame. All right, so this is really the beginning of learning some of the core trading ideas and concepts, and we simply have to start with the fundamentals, and simply this is our little tricycle that we have to begin with. All right, so start from the beginning, and we'll eventually learn to ride the big cycles. All right, so simply, what are pivots? As defined, pivots are turning points in price. But not only turning point, they're specific turning points in price. So here's a chart. And again, this was taken from way back in 2007. But you can see the series of pivot highs and pivot lows that create the downtrend, right, and create an uptrend. And so it's going to be at these turning points, once they're formed, and that's the key part of pivots, once they're formed, provide us an opportunity to place a trade, entry, or exit sometimes, okay? Place a trade with a specific risk amount. So if we're in an uptrend here, for instance, all right, we're going to be primarily looking to buy pivot lows once they're formed, and we'll be using, in the next module, we'll be talking about the right side pivot rule, and primarily we'll be using that as entry techniques. But we'll be using that to buy off of a pivot low to establish a position. Yes, the question here is, do choppy periods have pivots? And the answer is yes. Whether you're in an uptrend, a downtrend, a sideways trend, right? If you want to classify it as a choppy sideways trend, they all have pivots. Again, pivots are simply turning points. Okay, and we'll see actually an example of a sideways trend in an upcoming slide. All right, so what do we use pivots for? They're the building blocks of trends. I refer to them as the DNA of market structure. Their support and resistance, pivot highs, pivot lows. They can be used as objective entry and exit points. We'll see examples of that later. They're the core basis of trend lines, and they're valid in all time frames. So as a building block of trend, if the trend, as is in this example, is up, the green areas here denote the pivot lows, and the red shaded areas denote where there's some pivot highs. So as the market is being built directionally, all right, we're going to be using the pivot lows as support points, entry points, and we'll be looking for pivot highs as opportunities to take profits. But when you're in an uptrend, risk is higher to try to fade that trend, even at a pivot high. So the bottom line is, what we want to do is we want to stay in core alignment with the energy. And one of the phrases that we use is price goes where energy flows. So if the energy is directional to the upside, we simply want to be looking to buy pivot lows. Okay, support and resistance. All right, so uptrend, the green areas here once again denote support points. Those are pivot, turning point, pivot lows, and those will be used as entry points. And where the arrows are and the shaded red are pivot highs, and those can be used as exit points, and those are resistance. So again, they become resistance once the pivot is made. They become support once the pivot is made. We're not trying to guess where support or resistance can be. There are other tools that we can use in anticipation of targets that we may have in mind, but they're really not support or resistance until the actual pivot is created. Remember, because the pivot is a turning point, and it's a specific turning point, right, we're able to define risk using the pivots. If there is not a pivot, we don't really have a risk point. And that's going to be critical in our trading on a day-to-day basis. Whether you're day trading, swing trading, investing for the longer term, here's a daily chart. Doesn't really matter. A chart is a chart, and it follows the same principles regardless of the time frame. Okay, so as I mentioned, we use it for objective entry and exit points. So here in this particular case, all right, we're our initial enter at the higher low area down here, and as you can see, there is a pivot. And again, how you enter it is going to be your choice, but we're going to be highlighting in the next module, as I've mentioned, more about the right side pivot rule. And then as prices are moving directionally in your favor, okay, once a new higher pivot is created, that's when you can then move your stop, right? So you want to raise your stop to the next higher pivot. And again, this is valid intraday as well as it is on larger time frames. If there is a directional move underway, we want to catch as much as we possibly can with that. All right, and then here we go. As market continues to move higher, you notice in this area here, there's no pivot. It just keeps moving higher, highs and higher lows, it doesn't pause and pivot. Here it paused and pivot. It almost looks like a little sideways ledge, but that is a pivot. And then as it continued up here to the upper edges up near those 28s, then you can adjust your stop and raise it to the next higher low pivot. Ultimately, at that point, you got stopped out as prices pivoted on the high and came down. So again, we can use them for objective entry and exit points. All right, so that was introduction about pivots. We'll go right into pivot structure, part 2 here, and we'll go fairly quickly. So okay, so to start off with, we'll go pivot low. All right, a pivot low is formed when a price bar with a higher low closes above the previous bar's high, where the previous bar's low is lower than the bar before it. Pivot low is a support. Take your time and look at the picture. You may need to reread this definition several times to kind of, get a hold of it. The idea here is as prices are coming down, we're making lower lows and lower highs. A pivot is formed when the final low bar is in place and then price moves up above that high, the high of the low bar, but closes above it. And it closes above it with a higher low. So this is a typical 3-bar pivot, very common. We don't see them that often on intraday charts because intraday charts are much more fast and robust and fairly complex in how the prices move. As you go up in tick size or time, so a lot of in our membership we use 750 tick, 1500 tick, 4500 tick. When you take a look at a 750 tick, you may not see a 3-bar pivot low structure as readily as you would perhaps either on a 1500 or a 4500. Okay, but in any case, the structure still applies. What we're looking for is a close above the lowest low bar. Has to close above the high of that. So this is a simple 3-bar pivot. We're going to see examples of a complex pivot. Okay, so just the opposite here is going to be applied. So for a pivot high is formed when the price bar with a lower high closes below the previous bar's low. Now the previous bar's low is going to be the highest bar, where the previous bar's high is higher than the bar before. That's this one over here. And again, pivot's highs now are resistance. So again, think about that definition. You'll have plenty of opportunity to review it. But this is the basic structure of a 3-bar pivot. So we were asked about pivots in choppy, range-bound environments. So a pivot is a group of price bars, right, that indicate a change in price. So you can see here, this formation is more of a range-bound style market, right? So prices here, lower lows, lower highs, lower lows, lower highs. First bar that closes above the lowest low and has a higher low here, so that's that green bar. This forms the pivot down here. So this becomes a support point for potential future test. As you can see up here, higher highs, higher lows on these green bars, and then here's the first bar that closes below the highest bar in the sequence. Close below it. So there becomes the pivot high. Now again, this is a very simplistic example. There are multiple variations of this, and we'll see some examples of that. So just bear that in mind. I'm giving you an idealized view of what a pivot is. And they're not always as clean as, the examples that we show on PowerPoints. They can be rather messy, but at the same time, they still follow the same core structure, whether they're in multiple groups, they're in a tight sequence, or they're in a simple 3-bar formation. All right, so just add on to this particular slide. All right, we talked about there's your pivot low. All right, up here, higher highs, higher lows. This red bar that closed below this green one here, okay, creates the pivot high. Again, once again, pivot low. See how wide this bar is, right? Again, there's no definition or range for a pivot high or a pivot low. Okay, it can be as wide as the price bars, are there. But here you can see that this particular bar closed above this wide range red bar. That on the close of this bar, that's when the pivot is formed. So this is actually the confirmation bar. All right, it's not necessarily the entry bar. And we'll look at that when we start talking about right side pivot rule. Okay? But simply pivot highs, pivot lows, turning points. Okay, so here's the structure of the basic 3-bar pivot. Basic 3-bar pivot, any time frame, any tick size, doesn't matter. All right, but pivots represent the change in the direction of the price bars. So here's simply the 3-bar pivot sequence, right? Lower lows, lower highs. And as we finally put in a low bar, now at the time of the low bar, we don't know that's the low bar. We don't know that a pivot's going to form. So we have to wait for the actual formation. And when we're trying to anticipate a low, many times we don't get it right, and we're buying on down ticks into a potential support or selling on upticks into a potential high, but we don't have confirmation or any structural identification of whether or not that level is going to be true support or resistance. Once we have a good solid pivot in place, then the odds begin to favor that low is in place, at least for the very temporary, in order to assess putting on a trade, taking an entry, and then how much risk is involved. That's why I stress quite often, we don't want to be just buying levels for the sake of buying levels. We want to identify levels that we're interested in taking trade setups from, but wait for that pivot. I can't tell you how many times myself personally, and again, I tend to be aggressive, that I don't wait for the pivot because I'm blending in. So my style of entry for a position is I'll buy something at the level, but I'm looking to use right side pivot rule when the pivot is formed. But there are times where when I do that, the momentum to the downside is just too great, and I may buy something, I may take a fair amount of heat on it, okay, before it finally hits that low point and then pivots. All right. So what I'm trying to suggest to everybody is we're trying to eliminate, a lot of heat, okay, when we enter trades. So in order to try to eliminate that heat, wait for the pivot to form. Give yourself an opportunity to say, yeah, it looks like the sellers are done or the buyers are done, and the market's not, making any further progress to the upside, to the downside. So this is your basic 3-bar pivot. There are complex pivots. So again, just remember, for pivot lows, the price must close above the middle bar. Now again, when you're looking at tick charts, it's going to be very difficult on a 750 tick to start looking at, did this bar close above that level, or did that bar close below that level? It's going to be very difficult for you to determine that on a 750 tick. And I don't expect you to, and I actually don't want you to. If you're looking at a bigger chart, a 5-minute chart, or a 4,500 tick chart, or even a 1,500 tick chart, or something like that, then the bars are not moving as quickly. There aren't as many bars, right? And you're able to identify a little bit clearer where there is a 3-bar pivot sequence. When you're looking at these very fast tick charts, some of you have actually even used faster charts than that, it's going to be very difficult to determine, did that particular 750 tick bar close above that middle low bar? And it's going to be, you're going to drive yourself, a little bit crazy doing that. We can accomplish the same thing by using the right side pivot rule, and it used to be called the 2-bar high, 2-bar low entry method. And you'll see very simply, we're going to be doing a count back to look at what the highest high has been, or the lowest low has been in the past 2 bars or so, and then we'll be able to identify a price point of which, if price breaks through that level, you're going to have a close above that middle low bar or that middle high bar. All right, so again, we're going to discuss that in right side pivot rule. But in terms of just understanding the pivots, just understand this is the technique and the actual structure of a pivot high, pivot low. All right, so here's an example of what we call completing the pivot. Okay, so here on the left-hand side, we had a series of higher highs, higher lows. All right, then a pullback. So we have an uptrend. So we're looking for to buy on the pullback in an uptrend. Here, this particular bar, all right, so here's a higher high that's higher than the prior high. And then here's this thick bar here where it says completes pivot high. We have a lower high, and this particular bar closes below that middle bar. So technically that's a pivot, a high pivot, but within the context of an uptrend. On the flip side, here's your low bar, okay? Then the next bar here is a higher low, but it's not a higher high, nor did it close above that middle bar. So if you look at this bar right in here as the low bar, middle bar, this pivot low is not complete until this next bar, in which case it has a higher high, and now it closes above that middle bar. Okay, this is a very kind of fast chart daily. All right, but you can see here's a pivot high, then a pivot low kind of reverses all in a matter of 3 or 4 bars. That can happen. All right, take a look at this one. Here's your pivot high bar. And this is what I was talking about, where they can be a little bit more complex. Here's your pivot high bar. The next bar is an inside bar. The next bar is another doji. Okay, this particular bar here, all right, this third bar here, does not close below the low. It penetrated it, did not close below it. So do you have a pivot yet? No. You have a pivot when, unfortunately, this is a big wide bar, but that's when you have the pivot. Is it tradable? Probably not as well as, other pivots. Okay, so by this time, here it is, closes all the way down here, and you could say, okay, yes, I have a pivot, but now it's kind of formed a little bit of a range. All right, so this may not be the most ideal pivot to use for an entry. All right, if you were considering an entry. Here, as the price moved down lower, right, so series of lower lows, lower highs. Here's your final low bar. Okay, this particular bar that you can see, this long tail, all right, definitely penetrated up through that low, the middle bar's high. Didn't close above it though. Okay, so that's a no. This pivot low here is not complete until this bar. All right, so there's multiple kind of configurations, but the core of it is you need to have a close above the middle bar or below the middle bar of the highest to lowest bar. Okay, as we discussed. So again, you just kind of quickly take a look at these examples here. Higher highs, higher lows. There's your high bar. The next bar closes below the middle point of the middle bar, the highest bar there, and so that's a pivot high. Here's your lowest bar. The next bar here penetrates above the high, does not close above the high, inside bar in terms of the candle. The next bar, yes it does. So then there's your pivot. So it's once the pivot is formed, that's when you say, now I can buy it because I have a solid risk point underneath the lowest bar here. That's where I would be putting my stop. Now I have a pivot. If ultimately after you purchase it, entry, all right, again, this is a daily chart, but this is just as valid as when we're trading intraday charts. If after you enter, price doesn't accelerate, comes back down, stops you out, you will get stopped out. That's just the way it is. But if you follow this guideline about pivots, it will put you in a position structurally, all right, pivots are real-time profits, real-time structure for real-time profits. So the idea is we want to put ourselves, we need all the edge we can muster, right? Trade pivots, structure, and it'll put you in a position here, guys, to manage your risk much more effectively. All right. A special type of pivot, simply called a gap pivot. All right. We see them all the time, every day. They're nothing special, and we're not going to treat them as anything more than a regular pivot. We won't even, for the most part, we're not even going to be discussing gap pivots. All right, but simply a gap pivot is no different. Normally these occur on daily charts when there's an opening gap, and so the prior day is lower lows, lower highs, and all of a sudden the next day opens, and it opens with a gap. So the prior day closed somewhere on this candle here, and the next day opens up and you have a gap opening. Well, once the completion of that bar, then that is the pivot. Now, it may not be tradable and acceptable in terms of risk, for where an entry would be up here and your stop would be down here. So that's why I'm not going to spend too much time or even think about gap pivots, but it is a style of pivot, and simply it's just a normal pivot high or pivot low. It's a turning point. Okay, so we'll just keep that, in the back of our minds there. No different. On this next slide, here's a little bit more complexity, all right, where it takes more than 3 bars to form. So the simple 3-bar pivot is a nice, aesthetically pleasing pivot. Here we have multiple bars. So let's just kind of run through them. So lower lows, lower highs, and again, it's not even a clean lower low, lower high. We got actually an inside bar here on the left-hand side. Then we got another lower high and then a lower low that took out the prior low. And then the next bar here, we have a higher low, higher high, and we closed above the lowest. We closed above the high of the lowest bar. So that creates in this case, a 4-bar pivot. All right. Now, this is going to be important because a lot of what we see on an intraday 750 tick bars, we're going to see a lot of these. We're not going to see as many clean 3-bar pivots, but you will see a lot of these style pivots. Okay, so this is something that's going to be really important to understand. Now, in a case like this on the left-hand side, this becomes your signal bar or your confirmation bar of a pivot. Does not necessarily mean it's your entry bar. Okay, so what we're going to be using here is once the bar does close and it forms a pivot, we're going to be looking to take out one of these prior highs here as an entry point. Okay, so that'll be right side pivot rule. So again, many of you that have been using right side pivot and seeing these complex patterns know what I'm talking about. So simply, a lot of times we used to, in the previous slides, we were going, the 2-bar high, 2-bar low entry method would simply, you'd count from the lowest bar. You say 1 bar, 2 bars, and you'd say, okay, once it takes out this 2nd bar high up here, okay, that'll be our entry point. And really it works pretty well, and again, we've renamed it to the right side pivot rule. Simply, once we have a confirmed pivot in place, we're anticipating further strength. So that's where we're going to be looking to enter now. The entry may be a little bit higher. There are times where the opportunity comes even after the pivot is formed. Price will kind of dip down a little bit back within the range of the pivot. Actually offers us a better opportunity to get in. Stop is still going to be below the low. Okay, so next bar, again, kind of a choppy sequence here. All right, lower lows, lower highs, higher low, lower high, higher low, but does not close below this lowest bar. So here's the lowest bar. Here's the high of the lowest bar. This particular bar where it says no does not close above it. Penetrated it, doesn't close. Not until this one. That's the yes bar. That's the confirmation bar. All right. So again, here's a 5 bar, and then to the opposite side here. Again, a series of bars here that again is kind of very difficult to decipher. When they get really complex. That's why we're going to be using a much more simplistic method. All right, of again using that 2-bar high low. So here's the lowest low. What's the highest high of the past 2 or 3 or so bars? So when you take a look at this low here, you say, okay, here's 1 bar high, here's the 2-bar high. Now why don't we use this one? Because it's actually a lower high and a lower low, so you kind of X that out. So the idea is we're still going to be using approximately a zone, something between these 2 bar highs. You draw a horizontal line there. That's where we're going to be looking to take our right side pivot rule. We'll talk more about that in the next module. But you can see here how this complex pivot can be pretty, if you're trying to look at every hashtag here on the close, which one was the final one that cleared the lowest bar, the high of the lowest bar. It can be really confusing. We don't want it to be confusing. We're going to use a more simplistic method. But just understand, pivots often take more than 3 bars to form. And they're not aesthetically pleasing. The 3-bar pivot, is very aesthetically pleasing. So, let's review. The pivot low is completed when there is a close above the high of the lowest bar of the formation. You may want to reread that for yourself. The pivot high is completed when there is a close below the low of the highest bar of the formation. And as we've just seen with complex pivots, no matter how many bars it takes. It can be a little confusing. So you'll have plenty of time to review this particular presentation. Go over it as many times until you really understand it. Okay, but this is the core of everything that we're going to be doing moving forward. So pivots, we talk about that they're turning points. They're basically forces of supply and demand. Pivot highs, pivot lows. Okay, since they're turning points, that's where the balance changes. And we can go into the reason of why, demand is there or supply is there, or demand dries up or supply increases or dries up. All right? But to keep it simple, it's the point of where the balance of supply and demand equalize temporarily and then reverse. So on the way up, there's more demand because it keeps pushing price higher. At some point, that demand meets ample supply. It balances out temporarily. Again, however long that temporarily is. And then when the forces of demand and supply change, that's when you're going to get that shift or that turn or that pivot. So it creates the, in this case here on the top end, a pivot high simply can be defined as supply is greater than demand, in that the demand was met with enough supply to fulfill the demand, and then there was lack of any further demand, so the buyers dried up and the sellers wanted to sell more, so then technically that is when the supply actually becomes greater than the demand, creating a turning point. And vice versa on the downside. Supply is in ample quantity, pushing price down until the point where the supply actually begins to dry up and the demand at the lower prices start to absorb all that selling at some point, and so the selling dries up and then there's no more selling, and the demand, those that were buying it say, hey, I want to buy more. Where's the supply? No supply. They start bidding it back up. Guess what? Creates a pivot. So again, forces of supply and demand. Now with that forces of supply and demand, this is how we can create trend lines. All right, many of you know how to, trade those channels. Okay, and it's when you think about it, what you're drawing here, connecting, pivot highs and pivot lows, you're essentially creating a trend line, whether it's in a channel like this, all right, or just individually. And we can refer to these channels as the demand line. Again, that's the point of where supply dried up and demand was greater. Now, we don't know how much demand is waiting to be bought at a price. We don't know how much supply is waiting to be sold at a price. We only can make inferences after we see the demand pushing price up and then being met with ample supply and then reverses. And then the same thing on the supply side, where prices are being sold down to a point, and then the sellers dry up and the buyers want to buy them then. And then that creates, pivot highs, pivot lows, and then of course 2 points. You need 2 points to draw a line. So then you can connect those highs and lows and create your demand and supply line and create channels and all the fancy patterns that we like to use to define what supply and demand, or uptrends, downtrends. So simply, pivots are steps in a direction of price. All right, here's just a simple example of pivot lows, higher pivot lows, and then if you were to just simply draw your trend line there connecting the pivot lows, you have your demand line. And then you can actually forecast to some degree. All right, once you have 2 points, you can actually forecast the potential sometime in the future where there could possibly be a new demand at the extended trend line. Has anybody ever done that before? Okay, so that's a way of determining, hey, somewhere in the future here, if price pulled back, I'm going to be looking for a pivot at or around that trend line. Well, that trend line is, in other words, a demand line. Okay, so Steve has here. Yeah, it's very common, very popular. Right? I like doing it. Right? Projecting out just to have an idea, and then that may coincide with some other tools that you may be using. All right, retracement tools and things of that nature. All right, all that is all part of the you understanding structure, but the core of being able to draw that trend line or demand line or supply line in a downtrend is you have to understand where the pivots form, and simply they're pivot lows or pivot highs. So again, a lot of this becomes all of a sudden, geez, yeah, I understand that now, and I didn't really realize that until now, but certainly we're getting a core understanding now. So we trade the intraday, but many of you know that we also talk about and look at the higher time frame or tick sizes. So we'll just use time frame as the vernacular here. When we're looking at 750 tick charts, we're always saying, okay, look at the higher time frame, look at the 1500, look at the 4500. Okay, if you're using time charts, if you're using a 1 minute, 3 minute, look at a 5, 15 minute, something on higher time frames. And what you'll get here is you'll get that the higher time frame creates a pivot, All right, so chart is a chart, so there'll be pivots on the higher time frame, and many times they'll coincide with the lower time frame. So higher time frame pivots are stronger pivots, are more significant pivots than the minor ones, right, on the intraday. So as this little person here says, I need all the edge I can get. All right, so let's take a look at that. All right, so here is a chart of a daily, looks like MO, but let's take a look. There's a lot of, first when I take a look at a chart, what I like to do is I want to identify, where the pivots are. And so I'm looking, again, it's a very simple thing to do is, draw your trend lines and then go back in your trend lines and start identifying where the pivots are. Okay, so here's a series of pivots here. All right, so you get the green here is the pivot lows, reds are the pivot highs. And again, as it defines an uptrend here, you finally get a pivot high and a pivot low here, and then you get a new pivot high here, but it turns out to be a lower structured high, and then of course that ultimately turns into a selling opportunity here in the middle. Once it takes out the pivot low, so pivot lows here are support until proven otherwise, correct? We saw that on previous slides. Pivot highs are resistance until they're taken out, proven otherwise. So once a pivot low in a series of pivot lows that define a trend up or gets violated, which means trades below, all right, creates a new lower pivot, so now you have a lower demand line here. This subsequent retracement bounce tends to stop at the prior lower pivot here, the bull pivot. Now becomes what once was support becomes potentially future resistance. And then now all of a sudden you see this new pivot. Again, there's a complex pivot pattern here, but you can see the pivot pattern and then price subsequently rolls over. We see this often throughout the intraday period. This is a daily chart, but when we think about it, when we using an intraday chart, we're seeing this all the time. Okay, so we want to, that's why it's one of our core skills that we, need to, have and again practice and rejuvenate is the idea of reading and understanding where pivots are. When I take a look at pivots, guys, there's many times I've said in the trading room, I'm buying this lower pivot. I'm going to buy the pivot until it's proven otherwise. I'm going to sell the pivot until it's proven otherwise. Professionals buy and sell prior highs and low pivots. All right. They're not afraid to do so because they understand, that is where the structure point. Think about it. The demand line, the supply, the forces of supply and demand came in at those points. Professionals are not challenging whether or not that level is going to hold for support or resistance. It's going to assume that it is until proven otherwise. The uninformed trader, when it gets down to a prior low pivot, they're automatically assuming, oh, it's going to break, or the upside, it's going to break, so I better get on board on the short or get on board on the long before it happens because that's where I'm going to make my money. And you know what typically happens, right? They get trapped at the highs, trapped short at the lows. Why is that? Because they never learned what structure pivots are all about. You have the knowledge. You're the informed trader. So next time prices reach down to a low pivot, especially on the first test, or an upside pivot, especially on the first test, right? That's the time you want to sit up and look to trade that price level, okay, aggressively. And if you happen to get stopped out occasionally on that, so be it. But most of the time, you're going to be pretty successful doing it. All right, so something to think about. And that's why it's important to understand these pivots. So here's the same chart, but on a weekly basis of Altria. And in these same areas here, you'll see that, again, if we went back and started overlaying here, on a weekly basis, here's your stronger pivot zones. And then when you drill down into the daily chart or an intraday chart, so let's just assume these charts are 4,500, 1,500 down to our 750. Looking at bigger structure, saying, yeah, that's a bigger pivot structure on the higher time frame. Then when we drill down into the tick charts and we see that the tick charts on the smaller time frame are in alignment with the bigger, then it becomes fairly powerful. All right, so higher time frames definitely are an edge. All right, and here we go. We all learned how to, ride a bike, right? Our dad or our mom or whoever it was that helped you learn how to ride a bike, are they going to steer you in the wrong direction? Of course not. So same thing with pivots, guys. All right, they're going to steer you in the right directions. Really get to know them, understand them, make them part of what you're looking for on a daily basis with this stuff. Okay. Now, part 3, exits and entries. All right, we're going to try to go a little bit fairly quick here. Again, so pivots provide objective entry points. Okay, we're bombarded with a lot of information throughout the day. We have a lot of things we're looking at. The fewer decisions we have to make, the better. All right, again, many of you are reading some books as it relates to emotions and trading and so forth. Right, very important that we keep level-headed when we do this stuff. Okay. So simply, we want to buy higher pivot lows in an uptrend, sell lower pivot highs in a downtrend. All right. I talk about this on a day-to-day basis. All right. So it should be no surprise to anyone. We don't want to fade uptrends. We don't want to fade downtrends. We want to wait for the retracements and get on. Oh, by the way, premiums and discounts. Where do they form? Pivot highs and pivot lows in an uptrend and a downtrend. Okay. So we actually have a tool that actually identifies specific type of pivot that we look for our entries and exits on our setups. All right. So everything again is in alignment with these pivots. Now, on the next slide here, we'll just talk about ideas. We'll get into more detail using the right side pivot rule in the next module. But really on the longs, what you want to do is you want to enter on the completion of the pivot low. So think about that. And then what you know already about the right side pivot rule. We want to enter on the completion of the pivot low, not before. I asked one day in our trading room, can anybody identify the left side of a pivot? And for those of you who remember that question, you may also remember that it was dead silence. So you cannot identify the left side of a pivot until the right side of the pivot is formed. And that is the completion of the pivot. So once the pivot is complete, we have an opportunity for an entry. Your stop is going to be at the below the low, and your stop loss, if you get stopped, will be on a violation of that pivot low bar. Okay. Shorts on the other side, just the opposite. Enter on the completion of the high pivot. Your stop will go above the highest bar in the sequence, and a violation of that will be your stop out point. Okay, pretty straightforward, but again, need to review. So here's an example of the long pivot entry and exit with a stop loss. So as the price moved up and pulled back and created a higher low pivot, okay, this is your confirmation bar of the pivot. It's not necessarily going to be the entry long, although it may. So let's just assume it is your entry bar. You're able to enter on this bar. Okay, so you enter there. Your stop's going to go simply below the low. And the assumption is if we get it right, if it's a good signal, prices should not come back down and take out that low bar, and it should continue in the direction we're looking to trade. At times, though, all right, like we saw today, all right, with a little bit of news, we had a short on a premium, and we got stopped out in some news. All right, that's what stops are for. They protect us from serious harm. All right, accept the losses. All right, smile when you get a loss. Say thank you very much. I've protected myself from serious damage. I can come back from a small loss. Harder to come back from a significant loss. All right. Now, sometimes, depending on the style of trading, you may want to put in a looser stop, one not as tight, perhaps, to the lowest bar. That is an individual decision, all right, based upon your trading plan. There is no right or wrong, all right. You want to be consistent, but just understand if you have a wider stop, obviously, there's the potential for getting stopped out, and it'll just simply mean that you'll have a bit of a larger loss, but hopefully a loss that's not in excess of what you already plan as part of your overall risk assessment on trades. Okay, most of our trades, just for everybody's edification, most of our trades that we go after aggressively, premiums, discounts, bull bear stackers, those things, ATR trades, your maximum stop will probably be no more, depending upon the volatility of the time, should not be any more than 3 points, 12 ticks. Now that doesn't mean you're going to hold it for 12 ticks, a loss against you. It just means that our initial stop should be at least 8 ticks to 12 ticks, so 2 points to 3 points. In the event that there's a quick sell-off, a news item, Fat Finger Freddy, something happens, flash crash type of thing, we need to have some protection. So it's your maximum allowable risk, all right, and that's really for planning purposes. Most of the time, if we get the trade right and we get the setup right and it works, most of our actual true risk is probably going to be no more than about 4 or 5 ticks when you look back at it. All right, maximum risk. But for purposes of our initial stop loss, 8 to 12 ticks is what we're typically going to use. So remember, pivots are objective points, all right, for stop loss. So once that pivot is put in place, as I mentioned earlier, we have a specific point where we can place a stop and position size ourselves properly, okay? And so that's an important part. If you don't have a pivot, you are technically unlimited risk, all right, technically. Yeah, you can use a money stop, but a money stop does not really work effectively. You have to have a pivot. It's objective. And that's the key to this whole thing. Pivots are objective. If you're going to trade, you want to trade from an objective frame of mind, not a subjective emotional frame of mind. We still may be very emotional in how we trade, and there's not too much we can do to really avoid that. We have to accept that. But if we can place an objective way of doing things every day consistently, then it's going to be more important for us to follow an objective method, okay? So again, whether you're using a tighter pivot or the looser one, as it states here, it's going to be based upon your risk tolerance, okay? And again, I don't recommend that you place a stop that is so tight, because you don't want to get stopped out in noise. So here's just the short entry and exit. All right, pretty much the opposite here. You entered short, stop goes above the highest bar after the entry. So you could use this bar for entry, you could use the next bar for entry. Again, right side pivot rule. And ultimately, if the trade setup doesn't work out, you stopped out with a very small loss. Again, accept the losses. All right, hopefully, they don't drive you crazy. All right. Next slide. Again, just a wider stop we just spoke about. Okay. Okay. So pivots are objective entry and exit points for trade management in either a swing trade or a trend trade or day trade. But again, we're going to be more directionally oriented in what we do. So simply, trend trade up, pivot high, pivot lows. We're going to be entering on a pivot low. One of our exits. So somebody asked me today about where do we look for exits, right? Pivot highs are exits. All right, can be used as exits. Again, once we get ourselves to a risk-free point, okay, as long as the market, price is moving higher, right, and there's no pivot high in place, then, we want to hopefully continue to hold that position as long as, the market will allow us. All right. And again, one thing we have to also understand that try to get away from trying to buy the low or sell the actual high, because we won't know what the high is, nor will we know what the low is until there's a pivot high or a low in place. Does that make sense to everybody? So if by doing so, we wait for that pivot high or pivot low to take our profits as part of a method, technique, you're not going to get the high, nor are you going to get the low. So don't try to pick highs or lows. Right? We want to get the meat in between pivot highs and pivot lows. All right, so again, just another slide, works in both directions if you want to be on the short side, entries, pivot highs, right? And then we get a pivot low after you've taken some profit and you have a trailer, right? If you have a runner. All right, wait for a pivot low to be formed and say, okay, I'll take it off after the pivot low. Remember, you got to be willing to give up something to make something. All right, so there's always a trade-off, no matter what. Trying to pick highs and lows, what's going to happen is that you're going to be in a position and you're going to think this is the high or this is the low, and you're going to take all your all your trade-off, and yes, you will have a profit more than likely. And then all of a sudden it continues to go in your direction and you don't have any more. Okay, and nobody went broke taking a profit, but we also want to try to elevate ourselves to try to catch as much as we possibly can in a move. Now again, I'm making an assumption there's always these big moves every day, and we know that that's not the case. So we want to establish ourselves with a method and a technique to consistently get in properly at the right point, get scaled out on some risk-free, then get into management mode. It's not until you're risk-free. You can't manage a trade effectively until you have effectively taken the risk off. Once you've gotten risk-free, then you can get into management mode, non-emotional management mode, and you become much more objective when you do that. All right. So with stops, here's an important kind of reminder: you don't want to be arbitrary with them. Right? There's no, oh, I'll put a money stop down 2 points or 6 ticks or whatever. They have to be, and this is something I've stressed many times over the years, is that and I know a lot of you want to tighten up your stops, 3, 4, 5 ticks. That is really not an effective strategy. The strategy should be, where is the prior high or low pivot point? That's where the stop goes. Even if that stop is 2.5 to 3 points away, that's where the stop goes. All right. If you're trying to say buy 3 or 4 contracts, right? Because that's your position size. And a 3-point stop is going to put you over your limit for dollar risk that you're willing to assume. Then you know what you do? You put that stop 3 points away and you cut your position size from 4 to 2. Maybe even 1 sometimes. All right? But again, the idea here is you want to be in the trades that we look for. Get in there with at least 1. Get something on the books. Put your stop where it needs to be, not where you think you want to put it, where it must be. And there's a specific points, and that's based upon the pivot structure that we've been talking about. Okay? All right, pivots lead indicators. All right, all indicators are lagging. All right, price-based indicators, all right, MACDs, RSIs, all that, they lag. I think the only one is probably about as fast as price as possible is the CCI, and that's why we use it. That's one of the reasons why we use it. But still, it's still based upon price. So pivots are price, and they're real-time signals, so we want to make sure that we identify those pivots. All right, so trade the price. You can't trade an indicator. All right, it's like I'll give you an example. Since I'm a pilot, when we look at our instrument panel, there is what's called the primary indicators and then the secondary supportive indicators. All right, or instruments rather. I'm talking indicators here, but there's a primary instruments and secondary instruments, and it's the same thing here. Our primary instruments will be our attitude indicator and our heading indicator, and then there will be supporting instruments, i.e. indicators, airspeed, vertical speed indicator, those things, okay, altitude, those are supporting indicators or instruments. So price is your core instrument. Pivots are our core instrument, okay? So here's just a simple example. You see the pivot up here at the top, price-based pivot. Here we go, higher, there's your high, close below below the highest bar. Okay, there's your real-time signal. All right, excuse me. Even if it went down and came back up, that's still the price point where you'd want to, price level where you'd want to sell it. But notice here on this MACD, this signal didn't occur till several bars later. Okay, happens with a lot of indicators. So price-based indicators are much stronger. All right. So using real-time price signals removes the stress. We want to do that. Right. We want to be focused on good, proper decision making. Right. So that eliminates stress and indecision from trading, because we know simply where those price points, as they're forming, how they form, what we're going to do when they form. Okay. All right, pivot entries, precise, unemotional, and of course masterful here. All right, again, I'm just going to run through some further examples here. We're getting close. We're just right at the 1 hour period here in just a few more minutes. We're in a trend, enter on a higher pivot low, so in direction of trend. So here's the trend up, price pulls back, here's your lowest bar, right? So visualize a discount, if you will. Pull back within the context of the uptrend, pull back, there's your discount alert bar. All right, comes up, boom, you want to buy it. Takes out this highest bar here, boom, you want to buy it, you can add. Okay, so again, uptrend, pull back, pivot, right side pivot rule, entry. Entries could be at 1, 0.1, or 0.2. Okay, pretty straightforward. Stop goes below the lowest low. Here's the example of that on a chart. Straightforward. All right, in this case there's a consolidation, but it's within the context of an uptrend. Price pulls back, forms a higher low, pivot, confirm bar right there. All right, so now within the context of these bars here, you can buy it anywhere using right side pivot. Buy it this bar, buy it that bar, that. You can buy this bar here. Either one. Stop goes below the low. You're in it for the move. Okay. Here's the short side entry. All right. Same thing. Downtrend or consolidation. Primarily downtrend. Looking for premium. Right side pivot rule. Sell it. Market order. Again, we'll discuss ways of actually placing orders when we discuss the module, right side pivot rule module 2. and then we can add to the trade when the break of this reaction low. That's an add to the trade. We'll discuss that as well. Okay. Again, these are just ideal examples of what we look for and see every day with our premium and discount setups. All right. Again, should be pretty straightforward here. All right. Prices pivoted lower and a lower pivot here. So your entries on the break of the again, right side pivot rule, stops above certain highs. So talked about the trading range. I think Steve was asking, choppy periods have pivots. Yes. All right. So it's a little bit more challenging in a trading range. We saw, we've been seeing those past few days. As it states here, it's common for the price to test support and resistance, creating kind of head fake moves up and down. All right. Highs tend to be quickly reversed down. Lows quickly reversed up. Okay. Again, if you're going to use an entry, we can still use, if the range is wide enough, if it's a very, very narrow range, it's really difficult to use right side pivot rule. All right. But if the range is wide enough, it really creates a very nice opportunity to trade ranges. And again, our entry style won't be any different whether it's a range or it is a trend. Okay. Here's the example of a trading range. Okay. So again, if you think about pivots and understand what professionals look for in pivots, they buy and sell prior pivots until they're broken. So here's the first pivot over here. Here's the second pivot over here. Okay. When price comes down and tests that level, all right, professionals are going to step in and buy that. Okay, professionals are going to step in and buy it. Same thing up here, pivot high, price comes back up, they're going to sell pivot high level, pivot high level, pivot high level. That's what they do. The uninformed traders, all right, they're going to think it's going to break down or break out, and they sell the lows and buy the highs. I don't know why they do that, but that's what they do. Okay, they've never been taught. You've been taught. Okay, so buying near support and resistance lines. All right, here's some general guidelines. All right, only enter buy near resistance after the price has penetrated the resistance. If the higher high is made after entry, then resistance is now considered support. And vice versa, only sell near support after the price has penetrated support. If the lower low is made after entry and the support is now considered resistance. What is that? What do we mean by that? All right, a lot of words. Let's take a look at it pictorially, and guys, you'll absolutely see what I'm talking about. Anybody remember me talking about these type of patterns? What do we talk about? Prices in a range or some sort of consolidation, right? We wait for it to clear and convert, punch through, break out, if you will, whatever term you want to use, pull back and hold. Once we see that, then we buy on that pivot. And then that becomes the breakout point. Price is outside the range, right? Penetrated up through, violated down through. Right, it's the first correction is the safest place. You got it, Steve. Right, this is the first correction following a new swing. So this is an example of that. So that's what this is all about right here. All right. Again, it's very common to what we do, but I'm telling you, it is, once you're in a range, you can still play the ranges, buy the dips, sell the rips we talk about. But once it breaks out of that range, and we don't know when it's going to. I mean, we do have some clues, and we'll discuss those in a future module. But there is some ways of handicapping when a price is going to move outside of a range. But when it does, all right, we want to buy that, enter on that first pullback. Okay, no matter what. I mean, we see this happen all the time, every day. So here's an example of it on a real chart, right? So price comes up, penetrates above it, doesn't close, doesn't convert, boom, head fake. Here's the next one. Pulls up, penetrates up above it, now again, higher high, pulls back, holds, pivots. Now we're buying it up over on this side right here. All right, so we're not trying to get the lows. You don't want the lows. You don't want the highs. You want to buy them off the lows with a pivot, off the highs with a pivot. All right. And by the way, here's the little tell while I have this chart of that we can handicap this particular consolidation that is more likely to break higher. And again, this could be a daily chart as well as an intraday chart, doesn't matter. Notice the magnitude of the swings. Up, down, up, down, up, down. About even, right? Pretty much kind of, baseline tennis type trading, right? So the magnitude of each swings up and down are equal for the most part. Notice this swing here. Up, pretty much equal to the rest. Okay? A little bit beyond, but pretty much equal to the rest of what you've seen in the, prior. What about this pullback here? This pullback here where the arrow is, notice where it stops. All right? It stops at about the midpoint of the range. You see that? So when that happens, and it happens quite often even during the day, when that happens and it starts moving back up, now the odds begin to favor that upside breakout because the energy that pushed price down here is not the same. It's less energy than we saw on these swings down here. Okay, so that's why symmetry and swings are important. When the symmetry changes, something's changing. So we'll talk even more about that in future modules too in more detail. Okay, so again, another perfect example, right? Consolidation, symmetrical triangle, bam, a breakout, higher highs, pullback. Now again, what we're going to want to do is, since we have this higher low in place, remember, I've always said it's not about the price, it's about the price structure formation. We have to be willing when we get a price. Now, just consider this as an intraday chart. Price breaks out, pulls back, and it's making higher levels. And we say, well, I'd like to buy a pullback down over here. Well, guess what? We're not going to be able to buy that. All right? Because the energy and the new buyers that are coming in at these higher prices, all right, are more aggressive. So what we want to be doing is identifying the next highest low pivot. The next highest low pivot. Buy it on the right side pivot rule. And then there's no different. You buy it here, stop goes below this low. You're going to have a 2-point stop. It doesn't matter. You'll never buy them down here. It's not going to happen for us. We got to step up and be a little bit more assertive and aggressive on one after breakouts. And a lot of this occurs on bull and bear stackers. Okay? So we're going to need to really kind of rethink our entry tactical strategies, all right, to enter on these more aggressive moves. Because if we don't, we're going to potentially leave a lot on the table. And that's what we don't want to do. We want to, and I know many of you have asked me that before. It's like, how do we get on these, strong, fast breakouts? We're going to, again, talk more about that because that's a main concern of mine, to get these bull and bear stackers. And that's why I developed the bull and bear stacker formations, so we can identify when that shift in energy is coming into play. But again, the pivot of it is going to be the important. We want to get those. We want to, it doesn't matter how the pivot is formed. We get a pivot. We're not trying to buy that low. So right today, you are not trying to buy a higher or low. You're trying to buy an entry against a higher low pivot, or sell an entry against a lower high pivot. Okay, but we want to be using right side pivot. And again, by doing so, we're going to keep our risk uniform. All right, so we're just going to have a quick series of slides to end the presentation here. We're coming down to the last 4 or 5 slides. And again, I just want to show more of just a visualization of what we've been talking about. And then we'll be concluding the slides here in a moment. So with the sideways pattern here in this particular example, all right, we have a lower pivot down at the lower edge of the range. All right, so that is one opportunity if you wanted to play the lower edge of the range. Right side pivot rule will apply. Okay, so any of these bars here that we're pointing to, and then a breakout of the range, okay, would be another opportunity. Again, you have a pivot right in here. It's kind of, you got 1, 2, 3, 4. You got a 4-bar kind of pivot right in here on the breakout. Again, you want to be buying them here as well. So what we would see here in our charts intraday would be, this would be the bull stacker right in here, wouldn't it? All right, so visualize your charts, what it would look like. This would be the bull stacker. We want to buy a bull stacker. The key about bull stackers is that although we want to try to buy discount, bull stackers are going to be the unique cases we're going to be actually buying premium. All right, so we're going to need to discuss that in more detail to wrap our heads around that concept. Okay, but so again, pivots are an edge for seeing direction and knowing when to enter and how to enter. And again, keeping the risk in small under control is key. So here's your day E-mini futures. Okay, so whether a daily chart or whether it's an intraday chart, going to be the same. So price breaks out of a consolidation formation of some sort, makes a higher high, pulls back. As Steve was saying, first correction following a new swing high is the safest place. So what do we look here? Okay, and again, this could be a very likely intraday pattern. Where would the pivot be? Okay, so lower lows, lower highs here, an inside bar there, lower low, higher high, so that's a wide range bar there, but that's the lowest bar. Next bar here is an inside bar, so has the pivot formed at this point right here? Anybody? All right, has this right here, is the pivot formed? No, pivot's not formed yet until it takes out the high of the lowest bar. So where does that happen? On this bar. Okay, but we can anticipate that. We can anticipate taking out the high of that bar. So by drawing a line there and saying, okay, that would be right side pivot rule. All right, and then we would use that, and then a move up. All right, we breaking up on the audio. Okay, we're coming at the end here. Hopefully you still hear a little bit. The last couple charts, I'll just finish them up. Again, same thing here. Right side pivot rule, higher low, pivot, entries here. Okay, and then the E-mini Russell. Okay, breakout. And NASI futures. Okay, that concludes our session here for pivots, and we'll continue with the next module 2, which will be on the right side pivot rule.